Most people think $1 million will make you rich through dividends, but the truth might shock you. You see the headlines every day: how to live off dividends or escape the rat race with a 7-figure portfolio. It sounds like the ultimate dream. You hit that magic $1 million mark, flip a switch, and suddenly the money just rolls in while you're sipping coffee on a beach somewhere. But the unexpected reality of dividend income is far more nuanced than a simple math equation. If you go into this expecting a life of luxury without understanding the mechanics, you might find yourself back at a 9-to-5 job sooner than you think. Today, we are pulling back the curtain on what a $1 million dividend portfolio actually looks like in the real world. I've studied investing and passive income for years, dissecting the strategies of the world's most successful wealth builders. Today, we're breaking down exactly what $1 million in dividends really looks like when it hits your bank account. Whether you dream of quitting your job, retiring early, or just earning enough passive income to cover your mortgage, this video will clear up the biggest myths that plague the investing community. By the end of this video, you'll have the realistic numbers, the common mistakes you absolutely must avoid, and a clear roadmap for how to make dividends work for you, even if you decide that $1 million isn't quite enough for your specific lifestyle. Let's start with the most common misconception. Most beginners look at $1 million and think, $1 million should give me $50,000 a year, right? It seems like a reasonable 5% yield. In theory, that sounds great. $50,000 a year is a solid middle-class salary in many places, but here is why that expectation is often completely unrealistic. Dividend yields are not static, and they are certainly not guaranteed. If you chase a 5 or 6% yield just to hit that $50,000 target, you are likely stepping into a yield trap. High yields often signal a company in distress, meaning the stock price could be plummeting, or the company might be paying out more than it can actually afford. When a company hits a wall, the first thing they do is cut the dividend, leaving you with less income and a devalued portfolio. Furthermore, people forget about the trio of wealth killers: taxes, fees, and market risk. You don't get to keep every penny the market hands you. Depending on where you live and what type of account you hold your assets in, Uncle Sam or your local government is going to want a significant cut. Even $1 million won't automatically make you rich overnight if you haven't accounted for the friction of the financial system. The gap between expectation and reality can be massive. You might expect a smooth upward trajectory of wealth, but the reality is often a jagged line of volatility where your principal value fluctuates daily. To understand the truth, we have to break down the actual numbers. Let's look at practical examples. If you play it safe and invest in high-quality dividend growth ETFs like SEHD or VIG, or even the classic S&P 500, your realistic yield is likely going to sit between 2 and 3%. At a 2% yield, your $1 million portfolio is only generating $20,000 a year. That's about $1,600 a month. Could you live on $1,600 a month? For most people in the 18 to 50 age bracket, especially those with families or living in urban areas, that barely covers rent, let alone food, insurance, and travel. Even if you push it to a 4% yield by selecting dividend aristocrats or slightly higher yielding sectors like utilities and real estate investment trusts, you're looking at $40,000 a year. Before you get excited, remember we have to talk about gross versus net income. If those are non-qualified dividends, they are taxed at your ordinary income rate. If they are qualified, you might get a break, but you're still looking at a chunk of that money disappearing before it hits your grocery budget. When you compare this to other income sources like rental properties or a side business, dividend income is remarkably low maintenance, but it requires a much larger capital base to produce a quit-your-job level of cash flow. This leads us to the hidden realities and risks that many financial gurus tend to gloss over. The biggest one is dividend cuts. In 2020, we saw dozens of blue chip companies suspend or slash their dividends to preserve cash. If your entire livelihood depends on those checks, a 20% cut across your portfolio is a catastrophic event. Then there is the silent killer: inflation. $40,000 today buys a lot more than $40,000 will buy 10 years from now. If your dividend growth doesn't outpace the rising cost of eggs, gas, and healthcare, you're effectively getting a pay cut every single year. Market volatility is another factor. While dividend investors like to say they don't care about the stock price as long as the check clears, it's a lot harder to stay calm when you see your $1 million nest egg drop to $700,000 during a market correction. The psychological pressure of seeing your net worth evaporate can lead to panic selling, which is the fastest way to destroy a passive income strategy. Dividends are not a guaranteed paycheck. They are a distribution of company profits, and profits are never guaranteed. So how do you actually make $1 million work? You need smart strategies that go beyond just picking stocks with the highest numbers. First, you must diversify. Never put your entire million into just 5 or 10 stocks. You should be spread across different sectors: technology, consumer staples, healthcare, and industrials. Using dividend growth ETFs is often the smartest move for most investors because it provides instant diversification and professional management for a very low fee. The second strategy is the power of compounding. If you don't need the income right now, you must reinvest those dividends. $1 million portfolio that reinvests its 3% yield while the underlying stocks grow at 5% creates a snowball effect that is unstoppable. In 10 years, that $1 million could easily be $2 million, and your annual income could double without you ever adding another cent of your own money. Let's look at a mini case study. Imagine an investor who puts $1 million into a diversified portfolio with a 3% starting yield and a 7% annual dividend growth rate. In year 1, they get $30,000. By year 10, thanks to the companies increasing their payouts, they could be collecting nearly $60,000 a year, and their principal has likely grown significantly as well. This is the real secret to financial independence. It's not about the yield on day 1, it's about the yield on cost 5 to 10 years down the line. However, there are alternative approaches and surprising insights that most people ignore. Some of the most successful investors don't actually focus on dividends at all. They focus on total return. This involves holding a mix of growth stocks that don't pay dividends, like Amazon or Google, and then occasionally selling small portions of their position to create their own dividend. This can actually be more tax efficient in certain jurisdictions. Another approach is the bucket strategy. You keep 2 years of living expenses in cash or short-term bonds so that when the market crashes and companies cut dividends, you aren't forced to sell your stocks at a loss. You live off the cash bucket until the market recovers. Here's the part most finance gurus won't tell you. Living off dividends alone is incredibly difficult unless you have a massive margin of safety. Most people who retire on $1 million are actually using a combination of dividends, part-time work, and strategic capital gains. Most people are unprepared for the discipline and practical planning required to live off $1 million. You must be your own CFO, track your expenses, account for changing taxes, and be flexible when the economy changes. Not set it and forget it. Active management of a passive stream. Summarize the main points. First, sustainable long-term portfolio dividend yields are normally 2–4%. Anything higher often puts your capital at jeopardy. Don't forget taxes and inflation. A decade from now, what seems enough may not be. Third, hidden risks like dividend reduction and market volatility require cash and diversification. Finally, money management requires strategy, not luck. Instead of yield, focus on dividend growth. $1 million should be a tool, not a trophy, to bring freedom. Machines need upkeep. If this breakdown brightened your view of passive income and financial freedom, like and subscribe for more finance truth bombs. We'll cut through the noise and give you the numbers you need to succeed. Would you survive off dividends alone, or is $1 million just the beginning? Share your ideas below. Understanding the destination is the only way to assure you reach your investment goal. Thanks for watching. See you next time.